5 signs of an impending recession in the U.S., which of course will spread globally. Warning sign number 1 is the inverted yield curve. It's not the first time that the Fed has fought inflation. Here I show a chart of the CPI, or Consumer Price Index, or what we also call inflation, going up and down, of course, since 1954. In fact, what we can see is every time we get an inflation spike, we tend to then move into a recession or be in a recession by the time we get that spike. And I've now put onto this chart the federal funds effective rate, meaning the Fed's rate, and how they move. Generally, after inflation rises, they generally move to try to reduce inflation, which they've done at a pace that has not been seen since the 80s. So what we're going to see in this particular chart, what I'm showing is all the recessions since 1954, and then the federal funds rate on its own. And what can we see from this? Steep rate hikes have historically preceded recessions. The Fed's tool to fight inflation is raising the federal funds rate. And I'm just highlighting that almost every recession has been preceded by an increase in federal funds rate. All the way to 2008 recession, rates were rising into that, and even into the COVID recession. And now we have an extremely high and fast increase in interest rates. The result of that is that I believe we're heading into recession, just as we have in the past. In fact, if we look at the chart that I'm showing you here, it's the number of months from the first rate hike in a rate hiking cycle. This is the fastest and most aggressive rate hike cycle by the Fed since the 80s. After the 0.25 percentage point hike in February of 2023, the current rate hike cycle became the most aggressive since 1980s. The Fed has hiked rates by 5.25% in the current cycle, and this has resulted in short-term rates becoming higher than long-term rates, or what we call yield curve inversion. Let's look at the yield curve inversion. The yield curve has been inverted, and it signals for a year now, and it signals a fourth quarter 2023 U.S. recessions. In fact, all recessions in the U.S. since 1968 were preceded by an inverted yield curve. As it turns out, recessions typically follow. Now, the average time from inversion until the recession started in the past was about a year. That puts us dead set on fourth quarter 2003 of this year. And this is the first sign of why I think we have a coming recession in the U.S. Now, you can download this chart deck for free by clicking on the PDF link at myworstinvestmentever.com or by clicking the link in the description. There's 13 charts in this presentation. Warning sign number 2, peak employment. Many people say, well, Andrew, how could we be in a recession if unemployment is so strong? Here we can see that the unemployment rate is at an absolute low. Right now, we can see also from this chart, where I'm going back with unemployment and recession back to 1954, peak employment precedes recession. Every time. Every time that the unemployment rate comes down, 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 it is a signal that we're going into recession in the past. Now, unemployment now is at 3.8%, which is the same as April of 2000. This puts upward pressure on wages, which is inflationary, and on the flip side, a strong labor market can keep the recession at bay, but eventually we expect, and I expect, that this recession is pretty much here or almost here. Recession warning sign number 3, a slowdown in bank lending. Now, this shows a chart of all lending growth or loans in the U.S. rebased to 100 back in May of 2003, just so we understand how much they rose. The the loans that rose the most are commercial and industrial loans, as well as consumer loans. And here we can see that business lending has started to slow. That red line is coming over. And real estate and consumer lending is flat. And I expect that these two loans, real estate and consumer, are going to come down. And this ultimately slowdown in bank lending slows down the economy. Warning sign number 4, leading indicators falling and bankruptcies rising. The composite leading indicators are falling, but have seen a slight rebound recently. Now, this indicator looks at factors aimed at providing early signs of turns in the business cycle. While this indicator has given false signals before, recessions have typically followed large falls. The next thing is there's 72 U.S. bankruptcy filings in first half of 2023, which is more than the previous 2 years. Well, we also had 2 good years after the COVID bankruptcies. This is bankruptcies of private and public companies with over $100 million in assets at the time of bankruptcy filing. Now, this research comes from a company called Cornerstone, and I've got the link there, cornerstone.com, that you can see. Now, here we can see the filings of Chapter 11 over $1 billion and the filings of Chapter 11 with less than $1 billion. The key is that actually from a size perspective, it's still not a total emergency, but from a quantity of companies filing, it is serious. Let's look at this from another set of data. This comes from S&P Global. And I'll quote here what they say. Filings in the first 7 months of 2023 surpassed total filings for the previous year. What we can see here is there was 402 filings so far year-to-date July. That compares to 205 in 2022 and 256 in 2021. And it basically already, it's at the same level as we saw in 2020. All right, so recession warning sign number 5, the weakening consumer. Retail sales have been slowing, which typically precedes a recession. And we can see in this chart that retail sales growth basically has gotten close to zero. Will it go below zero? Well, there's a little bounce back right now. We'll see how that goes. But already, it's extremely low. And consumer sentiment has fallen since 2020. This is another concerning sign. Now, you could say, Andrew, consumer sentiment's down, and therefore we're going to see a rebound, right? A soft landing and a rebound. It's possible. But what we can also see is that we may be in a recession already, because what we're seeing in recessions from this chart is that consumer sentiment tends to be down in the middle of a recession. And the last chart that I have is credit card debt is at $1 trillion and growing, while past due bills are rising. This particular chart shows that consumer loans, that's credit cards and other revolving plans, has now exceeded $1 trillion. It's an incredible rise of what's going on. Now, the delinquency rate on credit card loans has risen from about 1.5 up to almost 3. So it's almost doubled since about 2020, the beginning of 2022 until now. This is still a small number. That's good news. When we compare it to 2008, it was all the way up to 7%. But still, it's a doubling in a short period of time. We're going to watch this chart. So, I see storm clouds ahead. What are the key points and the bottom line? The 5 signs. Number 1, inverted yield curve. Number 2, peak employment. Number 3, a slowdown in bank lending. Number 4, leading indicators are falling and bankruptcies are rising. And number 5, the weakening consumer. That is 5 warning signs of an impending recession that I see. Remember, you can download this chart deck for free by clicking on the Get the PDF link at myworstinvestmentever.com or by clicking the link in the descriptions.